Skycast, the official podcast of BluSky Trading. I'm Justin here for another episode, and once again, we are live. No edits, no redos, just some real-time insight with the BluSky coaching team. So welcome back, Riz, Becky, and Coach Matt. Now, let's just get into it. Now, once again, we have to start talking about the geopolitical climate, the conflicts, and let's just get into it. Is there anything you noticed? A lot of news has been coming out over the weekends, and it's hard to know what's true, what's not. You know, Trump will say something, it'll come out, nobody talked, things like that. So what are you guys actually believing? What have you looked at? And what are you kind of looking at going to the week that's really popping out with you? Coach Becky, let's just start with you.
I mean, I wake up in the morning. I don't know if anyone else does this, but after I do a little try to keep my mind steady and wake up peaceful, whatever. But I pull up the market so fast, honestly. What happened overnight? What is going on this morning? And it was a little bit of a wake up call this morning when I saw that giant pump that happened in an instant. So immediately I'm like, this has to be a news catalyst. Obviously, there is nothing else that makes these candles like this that we saw this morning pre-market. So obviously, I went straight to my news feed and was like, okay. This makes sense, right? The big news caused the big pump or dump. And we've been waiting. We have been talking for weeks on Market Skycast about waiting for these big news catalysts, and that when they happen, it's going to be a statement situation. And look at how it just kept sliding yesterday, just kept sliding, and the market's going to hell, blah, blah. But it had a nice deep retracement to a very key level, which is what we were all talking about when we were streaming last week of what an important multi-time frame, monthly tag level we were at. Is such an interesting level. Well, weird time for an announcement, but I mean, that's why I always just, watch your charts, be dialed into the news, because this was a big morning. My goodness.
Yeah, absolutely. I mean, you got to bring up the news before you even log on. You just have to. And like you said, that pump was weird timing, but it's just the new normal. It is what it is. On next to you, Coach Riz. Anything that popped out to you news-wise, chart-wise, anything that really got you going before you even started your week?
I think unfortunately, since I started getting into futures during Trump's first term, I've already seen this dog and pony show before. So, it's more of the same, really. It really goes back to what I've been saying in the Skycast the past few weeks, which is managing your stops and being very careful, because of it being such a news-driven market. You can throw technicals out the window because all it takes is a single tweet, a piece of information coming across, and the market is going to take a drastic turn. So definitely do not marry your bias. Keep your stops tight and be flexible. If the trend switches, switch. You need to switch. Don't marry it.
Great advice. And then Coach Matt, anything that popped out to you, anything specific about the news that had your brain moving, looking into the week trade-wise?
So many thoughts.
I know there's a lot going on.
So many thoughts. Well, I think you got to take a step back very quickly to understand the environments. Becky and Riz are absolutely right. In a moment of volatility, your technical analysis is no match for Trump tweets. That's the truth. But on Saturday night, the president put out an ultimatum, 48-hour ultimatum, which expired on Monday at 7 p.m. Eastern Standard Time. And that ultimatum was either open up the Straits of Hormuz or we will hit your entire energy grid, starting with the biggest power plant first. That is major, major, major escalation. And I think it was expected to see the president come out and respond to that before the market even got cooking this morning, because there was obviously a lot of concern regarding that ultimatum that was put forth on Saturday night. And so the president came out this morning and obviously, got in front of the press very early in the morning, 7:30 a.m. Eastern Standard Time, 2 hours before the market opened, and basically stated that Iran and the U.S. had agreed on 15 points to end the hostilities, and that the president is going to extend the ultimatum on the power grid five additional days to allow for negotiations to transpire here. Now, a lot of that most likely is Trump probably just getting his message out to Iran, because Iran did not confirm that talks had been taking place, and Israel came out and suggested this morning that take that Trump announcement with a grain of salt. And that's when you saw that snapback volatility and the pullback after that big move on Monday morning. And so, in a week where you don't have a lot of earnings reports and you don't have a lot of economic reports, and everybody in the world is laser focused on the geopolitical side of the equation, this is going to be a very sensitive conversation this week. But I did take it as a positive step in the right direction, speaking on the bull side of the equation. But the volatility is extremely sensitive. So I think for me, I'm looking at two things. I'm looking at, is this the conclusion of the short-term ABC cycle on the daily chart? And does the major level at 6,500, does that play a role in support build this week? And so for me, it's a matter of understanding the environment, understanding that 6,500 is a major level of support. And the number one thing that I personally need to see is slowing momentum here. And until we get some slowing momentum, this is still going to be a chiefly intraday conversation. But the news has been very aggressive for the last 48 hours, I would say. And it's going to continue to be very aggressive for the next 72 hours, I would say.
Yeah, great points. And I'm glad you brought up the ultimatum, and I'm glad you brought up, the shipping channel, because I think it's 20% of oil in the world gets passed through the Strait. And for me, I went out of town this weekend and I had to drive about 3 hours, so I had to fill my tank up on the way back. And I know you guys are on the West Coast. It's probably a little bit more expensive, but I paid over $4 a gallon in Florida, which is unheard of. So obviously, I was at a wedding last weekend, so I pulled on my phone and go, "What the hell? Oh, all right, this is what's happening." So not only for trading, I think just for the normal consumer's pocket and their wallet, you need to keep up with this. I'm thinking, what day do I fill up my tank? What day do I do this? Because gas goes up 50 cents one day just because of the news. So great points all around. So this is kind of a follow-up question, but let's just go Becky, Riz, and Matt. Are we strictly in a headline-driven market right now? And technical analysis out the window, and we're just playing intraday waiting for moves, or what are we looking at?
Okay, I'm so glad we're circling back on this, because I'm like, there's so many things to say. Okay, so first of all, when you are setting up to have a trading day, always, like, this is a big part that I feel like I need to always pay attention to, is my pre-market routine. Like, you have to have something in there where you're always making sure you're paying attention to all the outliers. Like, obviously in this situation, you see this giant candle, you're going to think news and you're going to search it up. But like, if everyone doesn't already do this, like, already have that as part of your plan. Like, you need to have the technical analysis, but also you need to have like the pulse on the general what's going on out in the world. And so, like Matt said, like, he came into this Monday having some awareness on that information that was coming down the pipe today, and so expecting the potential announcement could happen at any point because of the timeline that was given. And so I love that whole idea of making sure that you have in your pre-market routine to check on any outliers, any news headlines that could have an impact on your day, because then I do think we are in this climate of these like news tweet days that blow us out of the water. And I think that it's just like Riz said, man, you can't marry a bias and you have to be super careful. And honestly, like, risk management has to be top of the food chain today, because I tried this morning. I was stopped out, excuse me, because of the candles were so big. I entered my trade and it was a good trade and it actually won. However, I was not careful enough on the volatility, and I traded full size, and I wish I had leveraged down. And that in hindsight was an error, because while my trade was good, I was taken out at my stop loss, and it was my, the max loss that I'm willing to give on my morning trade. So I just kind of laughed. I'm like, okay, happy Monday. See you later. And so bearing in mind, when the volatility is higher, sizing down is absolutely so protective, because these big days, like, yes, it's great to catch a whale, but if it's moving and it's not normal price action, like, consider downsizing a little bit, because the points do print faster. So if your trade is good, it's going to be real good still.
Yeah, great points. And Riz, same question to you. Are we strictly in a headline driven market? Are you taking your trades any differently right now?
No, like I said earlier, really, I'm just listening to the news. I'm buying the rumor and I'm selling the news. Very much so right now. Because the volatility is just something you don't get all the time. And also, if something goes against you, you need to step out of it right away, because most likely it's just not going to come back. I mean, look, today was a perfect example of that. We got news that the war is over, there's negotiations, the market rips to the upside, 300, 400 points, it's just crazy, almost 1,000 points. And then all of a sudden it's like, well, that's not necessarily the case. So that's just, I can't make it any more simpler than that. That is the reality of what we're in. If you guys are not managing yourselves and you're just gambling then with the market right now. So really, I'm sticking to my guns on that. I'm keeping my ear to the ground and, being very observant as to anything that's coming up that might affect my trades.
Yeah, great point with the buy the rumor, sell the news, because these reactions are typically short-lived, and we just come back to equilibrium. And if you're trailing your stops, you're out. If you don't take profit, you're pissed off. So, Matt, let's get into that. What's the volatility playbook saying about these headline-driven news
It's
days?
saying, Becky, don't take full position is what it's saying.
Dude, right? What the hell? I think I was still on weekend mode.
That's what it's saying. I said this last week. I'll say it this week. As long as the volatility index is above 20, you got to be living in volatility playbook. And to answer your question, Justin, yes, we're living in a news-driven market because the market is laser focused on geopolitics. It doesn't mean that the other data coming into the market isn't important. Micron's earnings last week was important. Five Below's earnings report last week was important. The central bank last week was important. That was a catalyst event that sent the market down far more, in my opinion, than even what we were seeing on the geopolitical side of the equation. So it's not that economics and earnings and the traditional methodologies of the market are not important. It's just that the geopolitical cloud is taking up all the oxygen in the room. And so, yeah, we are absolutely in a headline-driven market, but and that has created volatility, that has created uncertainty, but there's still a logic technically to the marketplace. You might not like the overall direction and the volatility, but there's logic to the market. I've been tracking the market through the ABC cycle over the course of the last 3 weeks in this market correction, as I always do. And when you're going through a market correction, typically you see a short-term downtrend. You see a lower low, lower high, lower low. Well, what do we have? Lower low, lower high, lower low. When you look at kind of the behavioral elements of the market and you're thinking, all right, is there logic to the behavioral elements? Well, in the first movement to the downside, you move 350 points. In the second move to the downside, you move 350 points. There's logic there. There's technical logic there. When you look at the longer term side of the equation, you have this coming down to the 50-period moving average, which is obviously a very, very, very vitally important level of support. And the market buys off that level of support. And then on the intraday volatility today, you screamed to the penny to the 200-day moving average before you came right back down. And so, yeah, we are in times of volatility, but there's a technical logic here still. And it's a matter, especially for the bulls, it's a matter of letting slowing momentum really kind of work out, seeing patterns develop on the longer term side of the equation. And until that occurs, you're living on intraday charts. And even on the intraday side of the equation, I see technical logic here as well. Pump up, hit resistance, pull back down to the 9 EMA, you start slowing momentum at the 9 EMA. And so, yeah, there's news-driven catalyst, but after that news-driven catalyst gets built into the market usually performs technically. And so, yeah, I still see the technical conversation here being reigning king, queen, and country, and it's the truth of the market. And just because the truth of the market suggests volatility doesn't mean technical analysis isn't working. It certainly is. It's just suggesting that we have wide range volatility right now.
Yeah, and as Steve just said in the chat, it's F around and find out territory right now. And what you just said gave me flashbacks to your lab you did last week, intraday trading versus swing trading. And can't argue with you. Right now, it's an intraday market. Get in, get out, take your money, wait for something to happen.
As a swing trader, I've said probably 38 billion times in the last 4 weeks, this is not a swing trading environment.
I think every week you said it. Yep.
It's just not. Well, I have to, it's my way of reminding the community, but more than that is my way of reminding myself. This is not a swing trading environment.
Say it out loud so we hear it, right?
It's not. Scream it to the heavens. No, it's for the swing trader in me, it's a matter of patience plays, patience is a position, letting support build and letting slowing momentum really do the talking. Until slowing momentum occurs, there is no swing trading conversation. It's all volatility. And until that occurs, and I'm living on intraday charts. And right now, I actually kind of like the short underneath the low.
There you go. And that's some real-time advice right there. So if you're watching and you're watching live, that's what you get by watching us. We might see something and say it out in real time. All great points and great advice. I hope people really listen to this. But now let's transition. Let's go into a segment called Market Watch. This is where we're going to go over the economic data. Obviously, as Matt said, the geopolitical cloud is just looming over us, and everything has to do with that. But there is important things to watch on the market. We have earnings, we have economic data, and we have other things just besides conflict-driven news. So let's get into that. Going into the week, Coach Riz, is there anything that specifically besides what we already talked about that you're really looking at?
Oh, it's a fairly quiet week. What do we have going on specifically here in the market for the news? We're kind of out of earnings already. Tuesday we've got ADP, we've got S&P Global. Maybe S&P Global might give us some kind of catalyst and stuff. Really, we need something good from shipping to maybe help the chips sector. The chips being down. We got balance sheets on Thursday. I probably will gonna. I'm probably gonna maybe lean on Friday. We got Fed speaking. We've got wholesale inventories. We got Michigan inflation. You know what? I think Friday is gonna be the real day. We've had some pretty volatile moves. Maybe we'll see more consolidation, just like we're kind of seeing in today's session. That we had that big extreme move in the morning and no follow through in the middle of the day. So what does that mean? The market is eating alive the options chain. They're pulling in all that money. They're sticking it to retail traders. And hey, us on the future side, we're just kind of sitting here waiting for the trend to develop. So I think it might be more choppy, and probably towards the end of the week, we won't see any real move unless we hear news.
Yeah. And speaking of options, I've been hopping on your lunchtime streams, and man, if you're trading some 0DT options in the middle of the day, you are getting absolutely cooked unless some headline comes out, because it has been so
You're getting
choppy.
bled. You're getting bled.
And that's yeah. I'm so happy I'm a futures trader right now and not an options trader, because that theta gang is just getting wrecked right now. Now let's move on to you, Coach Matt. What are you looking at? Any earnings, any economic data, or anything else that you're kind of looking at? Because you are doing more intraday trading than ever right now.
I am. Oh, Justin, you know me. I always go to where you can see a trend, and you can't see a trend on the daily chart. All I see is volatility on the daily chart. And so to me, economically, earnings, there's not a lot of data this week that can really solidify any degree of conversation in the marketplace. And so earnings, there's just not an earnings report that has any degree of interest for the market this week, unlike Micron's last week and a few of the other ones the week before. But there is economic data this week that I do have a lot of interest in. Not necessarily from a tradable perspective, because I don't see the economic reports this week as being major catalyst. I think there's only one major catalyst this week, and that's what happens with the Iranian war. We're in a 5-day ultimatum, which takes into account this entire trading week, and it's going to be every single conversation is going to be on the alleviation or the escalation of that ultimatum. And so I think that's going to be the epicenter of all conversations this week. And I think it's the most important conversation to be had. Because if you saw the market response, just a whiff of hypothetical alleviation sent the market up 300 points on the ES in like 3 minutes today.
Yep.
And so I think that's the entire conversation. But there's a lot of economic chatter regarding how big of an economic impact the rising cost of oil is going to put on the marketplace, and whether or not that's going to put the economic systems around the world into recession territory. And although that's very early in the saga, I would suggest we do get some economic data this week to help us understand if that inflationary pressure due to oil, if we're seeing early signs on the economic side of the equation. And it's going to come in the PMI reports. It's not going to be in inflation. It's not going to be in labor. Those things are so laggy. Like they're lagging areas of the market. They get all the talk, inflation, labor, inflation, labor, inflation, labor. They get all the talk because it's the dual mandate at the Fed. But they're all extremely lagging. It's like the Titanic. They take a billion data points to get rocking in a trend. If we're going to see early warning signs economically, we're going to see it out of the PMI numbers. The PMI numbers on Tuesday are extremely important to me. And I'm not just talking about the US PMI numbers. I'm talking about specifically European PMI numbers, because the US is shielded a little bit due to the Brent crude versus US light sweet crude conversation. And so German, French, and European British PMI numbers this week will help us understand if there's early warning signs in the Eurozone. And if there's early warning signs in the Eurozone, you're going to see volatility in the S&P and the NASDAQ. Not necessarily the Russell 2000, which is shielded from European economics more so than the ES and the NQ is. But that's what interests me this week economically, is those PMI numbers, given the fact that oil is becoming a very big part of the inflationary backdrop and economic backdrop. So I'm laser focused on PMI numbers that come out tomorrow.
Yeah, that's a great point. And you mentioned the market ripped off of a hypothetical. So it's so weird how something comes out and then the other side says, we didn't even talk to them about that. And the market drops right away. So it's literally just instant reactions to headlines. And I like that you brought up Europe because, yeah, it could be a leading indicator of what's coming to us. So great points. Last but not least, Coach Becky, what are you looking at? Obviously, besides what we already talked about, anything that's pointing out to you to kind of set up your trading week?
Yeah, totally. You guys know that a big part of my strategy is sometimes there are news trades to be had, but this week is really light on that aspect. And for me as well, PMI Tuesday morning is the only real one that's on my radar in terms of something that might affect my trades, because that one comes out 50 minutes into New York session tomorrow. And so I especially be vigilant on that one, guys, technically, because if you're an opening bell trader, that's something that can really cause your positions either to fly right to profit or to be wicked out potentially. And that drives me crazy to get my trades wicked out on a news wick that I can potentially anticipate. So that 6:45 timing on any sort of news that potentially could have a larger impact is always on my radar for my trade setup. So that's going to be important for me tomorrow. But as we said, I mean, the geopolitical climate has got to be the biggest thing because it's international, it's concerning, it's changing rapidly, like minute to minute. And so for me, my intention is going to be trying to keep my ear to the ground on all news for that. But technically, we already have a massive candle for today. So far, we're getting a large wick on that. So I'm going to be extremely curious how this day closes, and then I'm going to mark my key levels. Because for me, when we get these large outsized days, we will often see, like Riz was saying, consolidation within that, trading back through that in order to fill out that low volume anomaly situation that it is creating with this giant pump. And so for me, I have on my radar that oftentimes we will see inside days after these outsized daily candles. And so at the end of the day today, I would encourage you all to think about drawing your levels on the highs and lows, where it closed, what the wick was, where the aggression was. And then I'm very interested to see how we react to those levels throughout the rest of the week this week. And wouldn't be surprised either if we don't actually have tremendous expansion outside of this range. That being said, I am on the bullish bias at this point because potentially, I mean, the leading mouth on the situation is Trump is bullish on the situation. And so I would look for prioritizing slightly the bullish plays if we can get nice pullbacks to support levels. So that's kind of my game plan for this week.
Yeah, I love that too, because I think it's hard not to be bullish because everything Trump says is like, we're winning, the war is over, blah, blah, blah. So you're at least going to get some kind of initial pump as a whole.
But he said that on day one of the war.
Yeah,
he said that every day. He's always winning, right? There's a million memes.
I think we declared victory like 18 times last week, guys, and there was still an ultimate over the weekend. So I get that point. I think Becky said something extremely important. The range of today's candle literally could be the range for the entire week.
Mm-hmm.
And that's I think identifying those key levels on this candle today, I think we're going to be talking about those levels all week long.
Yep.
Yeah, so guys,
We see that
just
a
keep
lot. These giant candles with wicks on either end, like you have to watch where it closes and where the key levels are drawn in New York session intraday, and those are the levels we're going to lean on all week. Agreed.
Yeah, so mini lesson right here is mark the wicks, mark the bodies of this candle, and see what happens at those levels. Great advice, great advice. Well, now that's what we're looking for this week from a technical side, economic data side, all that kind of stuff. Now we're going to go into the next segment, my personal favorite segment, Coach's Corners, because when I was a new trader, I had so many questions, and I wish I had professional traders that were just at my fingertips that I could just ask them questions and they would answer in real time. So let's go ahead and just hop into it. And this is a new one. Coach Matt, somebody actually asked you a question in chat about 5 minutes ago. So let's start with you on this one. Coach Matt, do you put any weight behind the overseas markets tanking due to the way energy is affecting their economies?
Yeah, that's kind of one of the reasons I was talking about the PMI numbers this week being a little bit more important, because when you look at crude oil, obviously seeing some alleviation here today, down around 88, was testing 100 earlier just in the session. That should tell you how sensitive this conversation is. We're down 10% in crude oil on an intraday move. But there's a growing spread between what's happening with crude oil and what's happening with Brent oil. Crude oil is the oil that we trade in the U.S. on the U.S. exchanges, at the Chicago Mercantile Exchange. It's light sweet crude oil out of West Texas. It's the oil we love. Well, we are energy independent in the United States, which means we are net exporters of all things energy to the rest of the world. And so we are shielded. Nobody's shielded from what happens in the Middle East. Oil's a global commodity, but we are shielded in a certain extent from the Eurozone and from the Asia areas of the market, because they deal with Brent crude for the most part. And that's what is pulled out of the Middle East. That's what is all in Iran. That's what everybody deals with around the world. And for example, light sweet crude oil is going between $90 and $100 a barrel right now. Brent in Oman last week was going over $150 a barrel. And so you've had this growing spread between, light sweet West Texas oil and what we're seeing in the international markets. And when you're looking economically, there's been a lot of chat. There's been a lot of chatter recently over the last week or so, especially after the central bank came out and said we have concerns everywhere regarding the economic recession. Probability of a recession has went up from about 22% up to the high 30s right now. And I wouldn't say that's a extremely elevated probability of a recession. But when you see what's happening with oil, especially on the Brent side internationally, it will cap growth performance in the markets. That's undeniable. And so when you're looking at the U.S. economic might, about 50% of all S&P 500 companies' revenues come from international. About 30% of all Russell 2000 comes from international. Of that 50% of revenue that comes out of the S&P 500 from international sources, 30% of it comes from the Eurozone, 20% comes from outside the Eurozone. And so, yes, I am absolutely taking into account the weight that Brent is putting on international markets and whether or not we start to see economic damage in the international markets, because we will see that economic damage first out of Asia. We will see that economic damage first out of the Eurozone, and those first leading economic indicators that will help us understand the totality of the concern is those PMI numbers. So absolutely 100% I take it into account in trying to understand my own projections on whether or not we will in the US go through a recession.
Absolutely great answer, and more importantly, great question by our own BluSky member Tip. So guys, again, keep these questions coming. You have professional coaches at your fingertips who know almost everything you can ask. And if not, somebody will answer. We'll figure it out together, right? But great answer, Matt. Now, this next question is from another BluSky member, Omoro. Riz, I want to ask you this because you've been streaming during the kind of lunch hour, middle of the day so far. So this is a question is perfect for you. How do you deal with a day like today where the move happens before open?
That's just one of those unfortunate things that if you miss the move, you just have to just move on from there. Look into your other strategies and see if you can find another opportunity to trade it. Keep in mind your risk management. You don't necessarily want to chase something because 9 times out of 10, it's going to pull back on you and the pullback will be pretty substantial. So, you want to make sure that, you're managing yourself and having self-control and realizing that that's just part of it. Sometimes you can't sit there at the chart 24/7 waiting for all your trades to come through. There's going to be plenty of times that you're going to miss all your trades and you're going to be flat in the day. You're not going to trade, and that's just part of trading. It's boring. You just have to take it. You just have to take it, and move on.
Yeah, and I like how you said it's boring. Trading should be boring if you're doing it right. You shouldn't be, jumping out your desk, swinging your around. It should be boring. If you are getting that excited, you're probably over leveraged, and that's for the conversation for another time. Now, follow up question to this: if you log on and you see, like, say you wanted that move, but it already happened, do you try to trade that New York Open, or do you just close the chart, come back in a couple hours, wait for maybe the PM session or when you're streaming, or do you still actively try to trade that and watch the whole time?
I try to treat it the whole time. It really depends on the time of day and what my mood is. That's probably the best way to put it. If I got the time and I've got the patience that I can sit here and I got other stuff to do, so I'll just move the chart off to the side and I'll just start working on other stuff. As of lately, I've been working on indicators, I've been working on some tools to help with risk management and order management. So now I'm expanding on that now, and that's one thing I've been trying to emphasize to traders. And you've talked about it here as well, Justin, is that trading just about just taking the trade. There's so much more to it. There's studying other indicators, expanding your tool set, developing your own tools, maybe even working with AI to where AI can give you confluences or add to your trade tools. I've noticed that as of lately myself. I'm feeding AI, order blocks. I'm giving it the whole, sheet of what I'm looking at, the order block on the cues, and I'm having it do the legwork while I'm trading Nasdaq, so that I'm maximizing my time and using my tools that now I'm beginning to become more familiar with. And those are the times that traders should be doing that, looking at other tools, how they can utilize them, and not necessarily taking away from the market, but to where you can complement what your time is here in the market.
Yeah, that's a great point. You mentioned patience. Obviously, if you miss the move, you need to be patient, wait for a setup. And you mentioned put the chart up on the side, work on something else. And if something presents itself, yeah, you can trade. But if not, just do some other stuff, paper trade, whatever else you were talking about. So absolutely great points as always. Now, last but not least, Coach Becky, this one is great for you because I know I went through it. You probably went through it, but you actually actively teach how to fix this. I win a few trades and then I give it all back later. What's going on?
Oh my gosh. It's a thing where you want to stay on a winning streak, right? When you're on a winning streak, it's so appealing. Like you can see the accounts building, it's growing. You're considering maybe skimming off the top, right? Taking a payout from your accounts. And so the appeal is there. Your energy gets behind the positive momentum of your charts. And then the issue comes when a trade fails, because in that situation, right, we're always anticipating. We're anticipating the next win because that's the streak that we've been on. And so when a trade starts to go against us, it's so tricky because you don't want to accept the stop. And that's where you have to really believe in your system and trust the variance and the probabilities, and that I don't know a trader alive who has 100% consistent wins. That's just not a part of the system. You have to put risk on, and there are trades that are losses. And so in that situation, I think it's where you trade with the emotional energy of wanting to stay on that winning streak versus your systematic plan of some trades are just going to lose and you're going to have to let it walk away. And for me, that's my situation. I mean, last week was a really strong week for me, and I literally woke up this morning and just had to laugh because my first trade was taken out with the volatility that we experienced. And so that's a situation too of like, I really preferred my P&L outcome of last week and not so much this morning. And so the urge was there, right, to like take it to get back in the trade. But I have my system lock me out, to be honest. Like I still feel the urge to be like, no, thank you. I would like to be green. I want to trade again, and I still battle that myself. And so I will set the locks on my systems. That way, if I hit a certain daily loss or a certain max amount of trades, it will just say better luck tomorrow, shut it down and move on, because that is a psychological thing of like, we want to continue on our winning streaks. And when there is a trade that goes to the stop out, it's an experience that is not pleasant. And so I think putting yourself, relying on your system, I think is a big part of this. When you're setting up for your trading day, review your trading system quickly. Have it written out, have your trade plan written out of saying, this is my trades, this is what I'm looking for, this is how I get in. And if I hit XYZ stop, I'm done for my day. And then when you're in your trading session, have a way to honor that. And if you can't do it with your psychological choices, put the locks in place. There are safety locks for your accounts there for a reason, because we're humans and we're not robots. And so this is a way to sort of add a little bit of robot to your system, saying, trade better next time, my friends. And so I personally am advocating for that and use that in order to allow my accounts to continue to grow. Because if you get into a revenge trade situation when you're stopped out, that's when bad things happen and the tilt spiral can come. So that's my best advice, is review your trade system right before you start your trading day to remind yourself of why you have your rules, and then to use those hard stop locks.
Great points. And my follow-up question was, is this psychology or risk management? But it seems like from what you're saying, it's both. It's psychology side, and then it's also risk management, because you can use your risk settings, lock yourself out, size down, actually use your stop loss to where you put it at, your take profit where you put it at. So it's a blended mix of both, right?
It really is. And I think that's what trading is, right? You have a technical plan, a technical setup, a trade plan that says, these are my ideal setups. This is how I get in. This is how I get out. If we trade that systematically, generally, if you've backtested and you have a strong system, that is a recipe for profitability. The issue comes in when our psychology overrides that. And so if you have a situation where you're still letting your psychology override that, then use these back end stops to just cut yourself off. And honestly, like, that's how we can control. I mean, there's conversations all around about how trading could be addictive for certain people. And if you still feel an emotional hit and you still feel a high energy and an enactment of your fight and flight response system where you want to fight back against the market to get back on the winning side, that's where you need to short circuit that potential spiral that you could engage in. And a hard stop on your account will protect you from going down that rabbit hole. It literally says, you're done, move along, get out. And sometimes that's just the right answer for a day.
Yeah, and you know how many times I've locked myself out of my account till the end of the day, and then an hour later I come back and I'm like, oh man, I want to hit that so bad, but it says user locked out. And you know what? It's benefited me more than it would have not. So great answers all around.
You know, when that happens to me, I almost always have a winning day the next day. And that's because I really have spent a lot of time on my system. And when I come back the next day, it's like, you are fresh, you are rested, you didn't take an outsized loss the day before, so your account is still in a safe zone. So you still have the literal capital and the mental capital to execute to your best of your ability. And not having carryover from a big loss is massive for psychological stability, because you're not coming in significant fix-it mode because you put yourself in a big hole. So having it capped at a reasonable risk allows you to rebound faster.
Yeah, great points. And we do have some time left, and I saw a question in chat, and then I have a question for you guys that I want to end the podcast with. But first of all, somebody wanted to get Matt's opinion on gold, and I'm very curious on this too, because gold was the hot toy in town for a bit. People have kind of switched over. I haven't heard too much chatter about it, so I'm kind of curious what you're thinking.
I'm getting ready to buy is what I'm getting ready to do. No, I think for a lot of gold people, looking at the last 4 straight days of down pressure on price has been a little abnormal, I would say. But the reason I say that is because of the environment. The environment is fear-based. That usually supports a gold bid. The environment is inflationary. A lot of people believe that would support a gold bid. And all of this is accurate. But one thing to keep in mind is in moments of real volatility, real concern, everything in the market has a delta of 1 and a beta of 1. It all moves with the market simultaneously. And I do think there's some things to understand with kind of gold over the last 4 trading sessions, which basically started with a scenario where before the last 4 trading sessions, you had 2 dojis sitting at the 50-period moving average on the daily chart. That was also kissing right up against the 5K significant whole number. The weekly chart was sitting on a bullish flag-based pattern at a major level of support, the 9 EMA on the weekly chart. Once you got underneath that, there was not a lot of technical support to stop the volatility. In fact, when you look at kind of the parabolic upward nature of the price to the left of the chart, in those times, man, it feels so good. Love gold. Like, it's amazing. But when the volatility hits, there's not a lot of support to stop anything. And so when you broke support last week, there just wasn't a lot of support until you started working into about 4,500. The volatility took it all the way down to 4,150, right around that 200-day moving average. And so I do think we're dealing with a major violation of support and the volatility that ensues after you violate a support. But I also think, when you think about the environment, you go back a little bit in time to the pandemic, for example. And when you look at the pandemic and kind of everything that transpired during the pandemic, well, guess what? Gold went down for 2 consecutive weeks during the pandemic when economically everything was shut down. I'd never seen a bigger fear situation in the entire marketplace in my career than what we went through in the pandemic, and yet gold went down. Gold goes down in those conditions, but what happens is gold stabilizes before the market does itself. And so gold will stabilize, in my opinion, quicker than the market will. And so that's just something to keep an eye on technically. But I do want to talk about causation very quickly, because after the Fed announced monetary policy last week, the general philosophy was higher for longer. And what higher for longer means is we will deal with a higher interest rate for longer than we anticipated. In fact, there was 2 Fed cuts priced into the market before the Fed met last week. Right now, there's no expectation of a rate cut this year. In fact, on the opposite side of the equation, there is a debate. 8% of economists poll expect a rate hike next month. That was not part of the conversation in this year so far. You go all the way out to December, and the most likely scenario is we have a rate hike this year. When you look at the Eurozone path of policy, the Eurozone is thinking 2 additional rate hikes this year. And so all of a sudden, last week, you go from a scenario where you're expecting rate cuts, 2 of them this year, to a scenario where now we're expecting 0 rate cuts, and a scenario where we could see a rate hike sometime this year. And that's in an environment where we're dealing with negative labor market data and negative inflationary data, meaning a stagflationary environment. That is very, very, very concerning. But when you deal with higher for longer, that's the one situation where gold will not catch a bid because it goes against the dollar. So that's number one. That higher for longer gets priced into the market, and then the market moves on and it goes to the next data point. So that's a little bit of what we saw last week, was the pricing in of the higher for longer, both within the backdrop of the ES as well as the backdrop for rate hikes are absolutely nasty for gold, RQ. 100% absolutely nasty for gold, because rate hikes, what do they suggest? You get paid a higher interest on the dollar. And so if the market's going to hike, you get higher interest paid on dollars, which means there's more demand for dollars and less for gold. And that's what really the relationship is all about. The demand for the dollar in comparison to the demand for gold. And so rate hikes increase demand for dollars. Rate cuts decreases demand for dollars. The second thing you had going on last week to really kind of impact the volatility here was Middle Eastern countries right now were not prepared for the Iranian war. And Iran made it part of their military strategic deterrence to attack the Middle Eastern countries. Well, that put a lot of economic pain around the market, obviously. But what it also did is it got the Abraham countries and Saudi Arabia to start spending more on defense. And so you saw military announcements last week out of the Middle Eastern countries that are all dumping gold. Think about this for a second, dumping gold to buy dollars to give to the United States to get more defense equipment to protect their countries. And so that's a short-term mechanic. And that was to the tune of about $30 billion last week. And what those Middle Eastern countries did is they started dumping gold to acquire the dollars necessary to acquire the defense contracts. So that was the second thing that happened. And then the third thing that happens in these environments, and I've dealt with these in gold a lot, quite frankly. The third thing is when you deal with true volatility in the market, you have margin calls, and you've had hedge funds get margin calls. And what a lot of hedge funds and institutions do is they buy gold to offset some of their riskier assets over time. And when volatility hits the market, they have to dump gold to pay down their margin calls. That's the third thing that is happening right now. And obviously it's having an impact in the bond market as well. But those three things were all simultaneously happening in the same environment while we were also breaking a major support level, and there wasn't a lot of support underneath that. I'm not surprised to see the additional volatility underneath 5K. I am a little surprised that it got very aggressive here today, but I see this more, and I saw it same way in 22 during the inflationary crisis 22 or the pandemic of 2020 or the first trade war of 2020 in 2018 or when they ended quantitative easing in 2015 or when we went through the subprime meltdown in 2008. Gold went down during the subprime meltdown, but it didn't stay down. And that's the thing about these market corrections is gold get caught up in it, but it usually finds a bottom before the market does itself. And so that's what I'm keenly looking at in gold right now is, have we found that bottom? And right now I'm shoulders formation, the intraday side of the equation, and I love it right back up above 45.20.
That's a great point. I don't think most people would think about, countries dumping gold to buy dollars. It wasn't on my radar at all. That does explain a lot.
That's why you have the podcast there, Justin.
That's why we got the podcast and the coaches. Now, we have a couple minutes left. I have a question myself because a lot of people, I see it on Twitter, I see it on Discords, I see it a lot of things, is people trading oil that don't usually trade oil. So I'm going to do a quick rapid fire. Should we trade oil intraday if we're not used to trading it? And then just a quick 1 minute answer, yes or no. Becky, yes or no, should we be trading if we're not used to it?
It has beautiful volatility, so do your due diligence and start with micros, but it's moving. So for me, it's a futures indice that reacts similarly to what I already trade, and it is on my radar. But when I trade it, because it's not my primary, I size down always into micros.
Great point. Riz.
I was going to keep at it, keep at the charts, manage my stops, and just be vigilant.
Yeah. Are you still using oil as a guide to trade the NASDAQ, or are you touching oil in general by itself?
Right now, I'm still using crude oil as a confluence, so I'm still tracking that heavily, just to see if the price is going to give us the telltale. It's been like that kind of tricky today because, it looked like oil was going to completely slip and slide, and it hasn't. It's been holding up. But the overall market is kind of doing that. That kind of goes back to like what Becky's point was earlier, is that, maybe the big move we saw today is probably the range we're going to trade in for the rest of the week. So unfortunately, I think it's going to be like that. And I'll still go with what I'm thinking that, we won't see a big move until Friday.
And Coach Matt, if you're not used to trading oil intraday, should you trade it? Yes or no? And why not?
So is the question, should you start trading oil in one of the most sensitive, volatile environments that we've ever seen? And
that's one way to say it. Yes.
No. I mean, why don't you go outside and jump off a cliff? It would be funner and less volatile.
Yeah, as somebody in chat said, yes, and then get blasted. And you know what? I agree with that.
I'm right there with I'm right there with RQ. Yes,
I did the same thing.
Go
I
do
hopped
it.
in
Teach
silver.
yourself some valuable lessons. No,
I
of
hopped in
course
silver
not.
when it was
Of
going. I
course
hopped in
not.
gold when it was going, and I got wrecked every time. So I'm going to
If
stay
you're a new
away from oil.
trader, if you're a new trader and you don't understand oil, no, of course not. No, absolutely not. You're asking for
I
pain.
feel like you just
Go
gotta
get
stand
punched
and
in the
say,
face
come
by Mike
on.
Tyson.
Yeah.
Have Mike Tyson bite your ear off. It'll be funner.
Yeah, that's kind of the answer. That's what I'm thinking. Like big hell no for me. Tight stops, we got this. Yeah. But anyways, that kind of wraps up our episode of Market Skycast. It'd be crazy not to talk about the geopolitical climate for most of the episode. So that took up most of our time. We did mention PMI, not too many earnings to really look at. And then we close off with some really great questions from our members. And once again, if you ever want to be featured on an episode, I'd love to interview you on your journey. Or if you want a question asked by one of the coaches, reach out to me, reach out to any of the coaches. And as always, we do have a crazy sale going on at BluSky. You can get a 50K account for $29. All you have to do is use the code WELCOME26. Go into our new dashboard, which I have a great overview that I just posted on YouTube on it. So if you have any issues on that, contact me, any of the coaches. I think we're going to keep doing this live. What do you guys think? You enjoying this?
Definitely. I like it.
Yeah, cool.
I like doing it Monday morning. I love having the information and being right at the head of a week and hanging out with our team here at BluSky is my fave.
Absolutely. So until then, we'll see you next week, Monday, same time, 1 p.m. Eastern. But until then, guys, stay profitable.
Everyone, take care.